A Guide to the Indian Stock Market. Hello and welcome to A Guide to the Indian Stock Market. If you're new to the world of stocks and investment, the Indian stock market can seem overwhelming. But don't worry, we're here to help you navigate it. The Indian stock market is one of the fastest growing stock markets in the world, with over 5,000 listed companies and counting. It's a vital part of the Indian economy, offering investors the opportunity to grow their wealth and benefit from the growth of India's businesses. In this guide, we'll take you through the basics of the Indian stock market, explain the different types of investment options available, and give you the knowledge you need to start investing wisely. Whether you're a seasoned investor or just starting out, this guide will provide you with valuable information and insights to help you succeed. Experts, now is a good time to invest in stocks. The experts we spoke with believe new Indian investors should take this opportunity to put their money to work in the stock market if they were holding off due to fear of another downturn. A lot of the pessimism has already been included in market valuations, with most investors already factoring in worst-case scenarios, said Nikhil Kamath, co-founder of Zerodha, one of India's largest brokers. Kamath notes that markets are forward-looking by nature, and that pricing today has already baked in the bad coronavirus news, but sentiment could rapidly turn negative given new, unexpected developments, he warns. Hemant Yanni, head equity strategist, retail broking, at Motilal Oswal Financial Services Ltd., observes that in the wake of past major market declines, like the one we saw earlier this year, India's stock market has historically delivered positive returns in the subsequent 6-month periods. There have been 4 instances, in the last 2 decades, of correction of more than 30%. In all 4 instances, 6-month forward returns for Nifty 50 were positive, while in 3 instances returns have been minimum 35% and a maximum of 46%, says Yanni. And for those who had invested before this year's downturn, staying in the market worked in their favor in many cases, as they were able to see their investments rise in the second quarter. Jimit Modi, founder of Samco Securities, says this time around, investors have demonstrated maturity by investing through the crisis with a belief that things will get better, and they haven't panicked as yet. Also, they haven't jumped to sell, exit/redeem their investments because of the fear of the pandemic, which is evidence of the fact that they have come of age. How to get started with investing. Investing in the stock market isn't as complicated as many assume it to be. It's easier than ever before to open an online brokerage account and start trading. The first step is gauging your own tolerance for risk, then deciding what to invest in. Investors may choose from these 3 main asset classes to build a balanced investment portfolio. Stocks. When an investor is looking at equities investments, the option to directly invest in a company stock isn't the only one. Depending on the risk appetite, investors can consider adding fixed deposits or simply starting a systematic investment plan, SIP. Yanni finds SIPs a good way to gradually build wealth in a way that limits the volatility in returns. He also advises allocation toward fixed deposits, which he considers safer than direct equity investments despite lower returns. SIPs are investment vehicles offered by many mutual funds to investors, allowing them to invest small amounts periodically instead of lump sums, with a frequency ranging from weekly, monthly, or quarterly investments. Mutual funds, which may be a medium risk and medium return alternative to direct equities, are touted as the easiest ways to invest in the stock market, according to Deepak Jasani, head of retail research, HDFC Securities Limited. Kamath thinks return on equity combined with the beneficial tax rates makes equity investments an attractive avenue to allocate capital at this juncture. Bonds, also called fixed income investments, help reduce volatility in an investment portfolio. The returns are often lower than equities, but they serve well to investors who want to be sure of a return to their investment. In this category, you can choose from a host of government bonds that come with a sovereign guarantee. Kamath advises allocating up to 20% of your investment portfolio in bonds. I would suggest tax-free bonds like NHAI and IRFC, which currently yield a tax-free rate of about 4.8%, he said. Cash equivalents. For investors who wish to consider investments beyond equities or bonds, financial instruments short-term cash equivalents can be considered. Marketable securities and money market holdings are considered cash equivalents because they are liquid and not subject to material fluctuations in value. Commercial papers or short-term government bonds with a maturity date of 3 months or less also feature among other equivalents that are available. Yanni suggests adding in a part of the portfolio toward buying commercial papers, an unsecured promissory note with a fixed maturity. The 1 to 5 year commercial papers look attractive as the Reserve Bank of India may follow up with more rate cuts, says Yanni. Consider building a mixed portfolio. A mixed portfolio would mean a combination of the three asset classes along with other instruments such as commodities, gold or gold ETFs, and real estate-based investments. Kamath advises a model portfolio that could include a 35% allocation to real estate, 35% to equity, 20% to fixed income, and 10% in gold, which could also act as a hedge on one's overall portfolio. Modi, too, bats for an asset allocation plan. If an investor is 25, at least 75% of his or her assets should be invested in equity or equity-linked assets, and the balance in debt and fixed income instruments. Once a plan is in place, executing the plan and periodically reviewing and rebalancing the same are the best ways to secure a future. Yanni believes investments should be linked with the future goals in such a manner that the investor does not have to scrounge around for money when he needs it. He suggests adding mutual funds, fixed deposits, gold ETFs, and government securities besides equities to one's portfolio. In conclusion, investing in the Indian stock market can be a great way to grow your wealth, but it's important to do so wisely. By considering your risk tolerance, choosing the right investment options, and building a balanced portfolio, you can take advantage of the growth opportunities in India's dynamic economy. Remember, it's always a good idea to seek the advice of a financial professional if you're unsure about any aspect of investing. Thank you, and we hope this guide has been helpful in providing valuable information and insights for your investment journey.